Property taxes are taxes that you pay on property that you own, and property is land and buildings. It's not like your car or furniture or jewelry. It's not that kind of property. It's like physical land and buildings. Now, if you own, say, a building, but you don't own the land, it's usually not like a solid building, maybe like a mobile home or something like that. Those you don't pay property tax on that. Property tax is a building that's like tied to the land, and it's not really a tax on the building, but the buildings drive up the value of the land. So it's really a tax on the land, but the buildings can affect the land value. Likewise, if you have old, dangerous, falling apart buildings, they can bring down the value of your land. Sales tax is tax paid on the value of the items you purchase. You are all familiar with sales tax. I don't know of anybody that hasn't had to pay it at some point in their lives. Sales tax and property taxes are local. They can be city or county based. And then you have income tax, which is paid based on the amount of taxable income you earn. Now, income tax is federal, and it can be state and it can be local depending on where you live. Florida does not have a state income tax. And I don't know all of the states that do, but I do know that California had a state income tax. So they still have. Yeah, they have a state income tax. So you have to pay income tax to the federal government, you have to pay income tax to the state, and then some places also have local income taxes, which are county based. So if you lived in those counties, you're paying county income tax, state income tax, and federal income tax. So we're pretty spoiled here in Florida where we only have to pay federal. We pay less taxes than other people. Your taxable income is the amount of money that can be taxed, and that's determined based on your deductions and exemptions, things like that. And then the IRS, the Internal Revenue Service, is the government agency that collects and regulates federal income tax. Okay, so your filing status is based on your life situation. If you are unmarried, so either you have never been married or you're divorced, you file single. If you are separated, you're still married, so you're not supposed to file single. You have to file as filing separately. If you're married, filing jointly, or a qualifying widower, that's a married couple that's filling out one tax form together and combining everything. Or a qualifying widower can file in this category the same year that their spouse dies, so that their spouse's information is still on there because they were alive during that year that the tax year is. But then after that, they'd have to file as single. So they only have 1 year that they can file as that if their spouse passes. Married filing separately, either you're separated, and so you're filing separately, or for purposes of perhaps you looked at your taxes and it makes more sense to file 2 separate tax forms so you're not combining your information. There's different reasons why you might choose to do that. And then there's head of household. Head of household is a special category. It is for people that are not married that have qualifying dependents. So your qualifying dependents may be your children. It could be like a sick parent that you care for, or maybe a sick sibling. But there has to be a qualification that puts you as head of household. And those people can't be earning income or contributing to the household. You're the head of household. You're the only person that contributes to the finances. Ron is single, and he's using the tax table. And I'm sorry this is so blurry, but he calculates that his taxable income is $51,482. So we need to find his. So we're in the 51,000, and on the tax table, if you look at your tax table, they're by larger increments, and then you look down underneath those. So we have 51,000. to 51,050, 51,050 to 51,100. They go by 50s. So if we come here, we've got 51,450 to 51,500. He's in between that range. He's single, so see we have single, married filing jointly, married filing separately, and head of household. Since he's single, we're going to look in this column and this row. And now that I've made it impossible to read, that was 9213. So this is how much tax he owes for the year. So let's look at Maria and Don are married taxpayers and they're filing a joint return. And their combined taxable income is $153,900. And the IRS gives you this tax schedule so that you can see how to calculate your tax. Now, if you look in the back of your tax table, these are there. And that's for amounts over 100,000 in the tax table. So they list these just so you can see how it works out, but really it's only for calculating in this range. So they're at 153,900. So that puts them here, which is really hard to see. Sorry about that. The stuff is just so blurry.
Yep.
Okay, so this is 131,450, and that's 200, 300, and this is 25,550 plus 25%, and then that's 131,450. Okay, so it's if your income is over this amount, but not over this amount, you calculate your taxes by doing this amount plus 25% of the difference between what you earned and this. So how are we going to calculate this? We're going to take oops, I left out a 5. That's how that works. And this 28%, sorry, I looked at the wrong column, it's 28%. So we'll turn those 5s into 8s. This is 25%. So 10%, 15, 25, 28, 33, 35. And then you take this amount plus that percent times whatever you made minus this number. That's the formula.
What's the formula I was writing?
Okay, so it's, let me write it in here. So tax equals column 3 times income minus column 4. I guess would be the way to say it, because it's 25,550 plus 25% of your income minus this number. Does that make sense? Sort of. Okay, so for this, for Maria and Don, their income is 153,900 minus 131,450. So we've got 25,550 plus 28% of 22,450. So 25,550 plus 6,286. So they owe $31,836 is their tax. Calculating Maria and Don's using that tax worksheet that the IRS provides. What we do is we say, okay, they are in this range, because this is 131,450 to 200, 300. So you put their amount in here. And then you multiply that times 28%. It gives you the directions right there. If you look on the clear one that you have a copy of, it says times 28%. Well, when I multiply it by 28%, I get 43092. And then it subtracts. The next line says subtraction amount. I subtract from that. So basically what we've done is 153,900 times 0.28 to get the 43092. And then I do 43092 minus 11256, which is that number that's here that you can't really see, which gives me 31836. Now, why do they do this instead of just letting you do this? This is easier. So less people would make a mistake because it's got the directions. It says take your income, multiply it by this. It even has the decimal there to get that, and then subtract this from it to give you your tax. Okay, so your gross pay is how much money you earned before they take any of it away. That's your, if you're on hourly, it's your hours times your hourly rate. That gives you your gross pay. Your net pay, however, is the amount of money that you take home. And how many of you guys have jobs? Okay. And you've all noticed that your net pay is significantly less than your gross pay. Yeah, that's because they take out all the deductions. Your paycheck stub will list all your wages and your deductions. Some companies don't give you an actual paper paycheck stub. Like I don't get one. I can look it up online though. So it may not be an actual paper, but it lists everything, and they are required to give you this listing either electronically or on paper. They have to tell you what they took out and why. They can't just willy-nilly take money out and just be like, oh, it was, thing. Your W-4 is the form that you fill out when you get the job that you are telling them how many deductions or exemptions you're claiming. It's technically called the Employees Withholding Allowance Certificate. You determine how much money is being taken out of your check for taxes by claiming however many people you claim. If you claim more people than you're actually allowed to, it won't get caught here. They don't care. I could claim 20 if I want to on my withholding, but when it comes time to file my taxes, I can claim, like 2, me and my son. So if I claimed 20 on my W-4, that's fine, but now I'm going to owe all that money that they didn't take out of my check. So you want to either claim the exact right number or less. Because if you claim less, then they'll take more out of your check and you won't owe money. And then the withholding taxes can be federal, state, or local. For us in Florida, it's just federal. We're nice that way. Your W-2 is technically your wage and tax statement, which is due to be given to you by January 31st. That's the deadline. They have to have it to you by the end of January. And it is the total of all of the taxes, Social Security, and everything that had been withheld throughout the prior year. And then a 1099, you may or may not receive one of these. You get a 1099 if you have any earnings that are not straight wages. So contracted work, dividends, interest earned, things like that. So not everybody gets a 1099. So if you'd ever got one, you don't have to worry about it. That just means you didn't do whatever to get one.